Hello, everyone. I'm Alex, and welcome to Retire with Style. I'm here with Dr. Wade Pfau. I don't think I've ever
Hi,
said that
everyone.
one, Wade. and Bob Robert T. French.
That's right. Yeah, just to put it out there, I'm actually the least educated person here. I'm the only one without a PhD. So
No, but you're a
Dr.
CFA charter
Maria as
holder.
well. So
No, Bob, the only one that can call me doctor is my mom. So, she's required. Everyone else, it's Alex. Seems more natural that way. Besides, if you tell everyone that, they'll all lose faith in the educational system.
So there is that risk, I guess.
Yeah. So on with the timing, right? Today's episode, we're going to drill down into market timing, and not steal the thunder here, Bob. Why don't you give it the tight five before we get into it again?
I don't know that I have a tight five on market timing or anything, but the basic idea we've talked about, the past 2 weeks, kind of the opposite ends of how people approach trying to beat the market, for lack of a better way of saying it. So a couple of weeks back we talked about technical analysis, which is the crazy chart people who think you can look at those charts of stock movements and be able to predict what's going to happen next. Last week, we talked about fundamental analysis, which is the crazy spreadsheet people who want to run all of the numbers and figure out, the exact price that Tesla should be trading at or what the S&P 500 level should be. And then, hope the market catches up with that. Today, we're talking about kind of the wishy-washy middle. Which is kind of the general approach to market timing, which is, for lack of a better word, kind of just trying to guess where the market's going to go. Is the market going to go up? Is the market going to go down? Is this stock going to go up? Is the S&P 500 going to go down?
So it's kind of in the middle of both.
It's in the middle of both. And people pick and choose from both kind of approaches to figure out, how do I get, at least in my opinion, how do they get to the story they want to be telling? I kind of think the market's going to go up. What can I cherry pick from both of these different schools of thought to get me to that result?
Or could it be sort of an endurance thing? And what I mean by that is, let's say someone's doing fundamental analysis, right? And they're by their third balance sheet adjustment, right? And then they say, 3 days into it, you know what? The hell with this. How does the chart look like? How does this chart look like? You know what? I'm good. I'm buying. It could be like that, where someone just gets exhausted and says, let me just look at the chart. Or they're at the charts and they have so many different signals. They're like, one says buy, one says sell, one says hold, one says neutral, one says strong buy, one says whatever, And they're like, let me just quickly go to Yahoo Finance and look at the financials and the basic PEs, price to sales, trailing 12 months, and call it a day.
It's the shortcut. It's, Wade?
I don't follow the cutting edge of the market timing research discussion necessarily.
Sure you
but
don't.
Is this something?
Sure you don't, Wade.
This is more looking at market indices, right? Is it also people are trying to market time individual stocks?
Oh, yeah,
or
they'll
are
market
they
time anything?
Oh, okay.
They'll market time the length of your beard if you give them away. So.
Well, I think what Wade is saying is market timing individual stocks is kind of jumbo shrimp, kind of an oxymoron to some extent. The way market time. Yeah. So I think maybe they're using exactly. Maybe they're using like a macro analysis tool to kind of also dictate, because there's the argument of it's hard to fight the Fed. So to some extent, an individual stock move is going to have some component of that. By the way, Bob, a more pressing question. And for those listeners, please earmuffs. If you don't want to. Wait, are you cold? Wade is in Dallas.
I am cold today.
Bob and I are in the Northeast, and Wade is like all like park it up. park. And we're like, what? It's freezing in there?
Yeah, the weather is pretty wild and volatile these days. And
it was
by the
70
time
degrees here.
It was here too. It's not anymore. I think we're getting the tail end of that storm going through the north part of the country.
Okay. All right. For those listeners, you can take your earmuffs off now and we'll continue. I was just surprised. Wade is like he's dressed like if he's ready to go outside kind of thing.
Yeah, I am. But by the time people listen to the episode, it may be 80 again. So who knows?
All right. So Bob, macro timing is an oxymoron for an individual stock, but it's not because.
Right. So this is where kind of it comes down to that wishy-washy, and the terminology is really, really just kind of all over the place. You could, as you're doing, making the argument that, market timing is really this big, broad thing. Do I think the market as a whole is going to go up or down or whatever? And doing it at an individual stock level is something slightly different. But, we're kind of lumping it all together in saying, okay, I think Tesla is going to go up or it's going to go down. And, maybe there's a slightly different term that we should be more precise in using. It's kind of all under that same rubric. You're trying to guess where the market is moving and move your investment strategy or your investment tactics more appropriately along with that.
Okay. Wait, did that satisfy? Since you brought it up?
I never really thought about market timing from the perspective of individual securities. I suppose I would think of that more as technical analysis, but yeah,
it's a very blurry line. So
fair enough.
Okay.
Fair
yeah.
enough. So we've established it's some sort of hybrid between, because it may, to the extent that there's any theory behind it, it's probably drawing both from the technical analysis tools in terms of talking about, well, we're above the average over the previous 6 weeks.
I would say it's exactly what CNBC does. So Alex, your lunchtime viewing, that's by and large, that's the market timing stuff. They're pulling little bits and pieces to tell the story they want from, hey, their balance sheet looks good, the prospects are good, versus, hey, they got this resistance level at the same time.
Bob, unless you've watched Power Lunch with me,
Uh-huh.
Please refrain from any opinions.
Uh-huh. Okay.
Okay? Because you don't know what I'm watching. You don't know what they're talking about. Those first 10 minutes are gold, Bob.
Okay.
All right?
Okay.
No. It's true. The issue I get with the market timing piece, and I think there's a lot of platitudes out there, right? It's not timing the market, it's time in the market. Aha, that kind of thing. But I would say this, if we get, as prospects come in and we have meetings, and I don't do these anymore, so many of you would be thankful for, but as there's these meetings that occur, etc. What we get a lot is, I think the general consumers understand this, and there's kind of a little bit of a scarlet letter to say that I'm a market timer. And there's a lot of people that say, oh, I'm not a market timer, because they think that's your everyday going in, getting out, getting in, getting out every day, right? Or every whatever, right? But it always comes around like, I'm not a market timer, but, and we'll talk about, but the market is obviously overvalued. And so there's no way I'm going to do whatever. But it's obvious the market is undervalued, and there's no way I'm going to do whatever. I think that's where it's in many ways more nefarious than if you were just an open, I'm a market timer, guilty, kind of thing. Because at least there's some level of acknowledgement. But the folks that get me, that I think really, they can do okay, are the ones that are one of these like closet market timers. I'm not a market timer, but if you find yourself kind of talking, to somebody else, and I'm talking to Bob. Hey, Bob, when COVID, was happening and we were all locked down, and after the markets went up, you know what? I had to sell Zoom because I realized it was so high and it had to go down. I don't usually do this though. I just did it with this one, or I just did it once or twice in my entire life, or things like that. That's a very slippery slope. From my experience listening to people, there's two scenarios that usually happen. The one that doesn't is they get it right, then 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 they get it right, and they own the world. That never happens. I haven't run into anyone like that yet. So maybe I can't say never, right? So that's outside of normal limits in a major way. What usually happens is, look at this. I got it right. I'm a genius. I got it right. Bow down before me. I didn't get it right this time. It happens. I got it right. And after a while, they just follow a random pattern, and hopefully they haven't run out of money. But I think the most dangerous thing to market timing is to get it right the first time, because then, I don't know, there's this sort of rush. And I that's my PSA announcement for the day, or at least for the first 10 minutes, is there's market timing, like folks that are CNBCers, that kind of thing, right? But then there's market timing, these under the water market timers that won't admit to others that they're market timing, and they rationalize to themselves, I only do it a couple times when obvious signals are there.
Yeah, well, and there's certain behavioral biases that just with behavioral biases, I think it's natural for people to be able to tell themselves the story that either they forget the times that they didn't do it right, or whatever the case, or just they have this feeling that markets may go down or they may go up, or whatever the case may be. But then the trick is to not act on that and to not trade on that. You recognize, like when COVID was happening, I was like, oh, okay, I think the market's going to go down. But then the important thing is to not act on it and to not panic and sell everything. And that's where really trying to have some sort of behavioral way to manage this sort of natural tendency to want to market time because it's a story that can sound nice to people. That's where the real discipline comes in, is to not act on those thoughts.
It's even more than it sounds nice. I mean, it's literally how we think. We're worried about, say, the market going down or missing out on this really great market opportunity where it's going to go up. So we do something about it. And the dangerous thing is, as long as we're saying the market's going up or going down, you got a 50-50 shot. It's effectively a random walk in pretty much any reasonably short time period. Half the time you're going to be right just by chance. And then you keep building on that, as Alex was talking about.
But you have another point here about the probabilities, but let's push that back for a second, because I want you to address okay, all right, guys, I get you, I hear you, but you know what? I'm not using my spider senses to tell me to get in or out of the market. I'm actually using traditional valuation ratios. I'm not using the triple Linding. I'm not using the Fibonacci continuum. I'm not using string theory or whatever. You know what I mean? I'm using actual hardcore, traditional, tried and true valuation metrics like the PE ratio. And the PE ratio is, whatever, way above its historical average. So you got to be kidding me telling me that it's not going down.
Yeah, so this is one of those where it's not as cut and dried of a soundbite as we might want to be able to make, because there is value in the PE, in the CAPE by extension, in a lot of these different metrics, because it gives you information on the price relative to the fundamentals in the economy. And what that does is it gives you at least a little bit of a sense of what forward-looking expected returns in that market, or whatever that valuation metric is telling us, or is looking at, I should say. It gives us some general sense as to what the expected return might be in the future. Now, the question then becomes, okay, how much play is there? What's the error bar around that type of thing? And those numbers are just phenomenally massive. There are some very intelligent people who I respect immensely who, do make a habit of calculating out, here's what the current PE ratio or the CAPE ratio implies for what the expected return is going to be. And they'll do it out to like 4 decimal places. Beyond an intellectual exercise, I don't think there's any value there. I don't think it's any value in terms of, at least at a tactical level, how we build out our portfolios. At a strategic level, when we're designing our very long-term asset allocation, that's definitely a piece of information to be using. But I wouldn't be looking at it in terms of, this means I should buy more or this means I should buy less. It's more of, over my 30-year retirement horizon, kind of what numbers do I plug in for my planning purposes? And Wade, you had a good point on this about, Shiller when with his papers and a lot of the stuff around the CAPE ratio there as well.
Yeah, I mean, Shiller wrote his article on the CAPE ratio, the cyclically adjusted price earnings ratio. I think the first one came out in 1998. And when you looked historically before that point, it provided pretty good predictive power about that's fitting the line through the data. When the CAPE ratio was high, the subsequent stock market returns tended to be lower and vice versa. But it's kind of like what happens with a lot of this. Once people saw that point, the relationship broke down. And if you were following that sort of guidance, you would have been spending most of your time since the mid-1990s with a lower stock allocation because you were worried that markets were overvalued and you would be experiencing a lower return from those stocks. Now, we've seen there's been a lot of years that have passed since the mid-1990s. And for the most part, it probably wouldn't have been a great idea to have a lower stock allocation that whole time because you were worried that because the CAPE ratio is predicting lower subsequent stock market returns. And that's where I think ultimately planning conservative assumptions for retirement, you might not want to assume historical stock market returns when the CAPE ratio is higher. But beyond that, I don't think we can really glean a whole lot of information from something like the CAPE ratio.
No, I agree. I think, and Bob was making a point with regards to these fundamental levels and the like, and it's not like the CAPE ratio, and let's just say use CAPE ratio and PE interchangeably, right? They don't go up, they don't double overnight. Mm-hmm. They don't double. It's not like you woke up today and wow, the PE ratio is at 40. It was 20 yesterday. Something's off.
What if the stock market doubled?
No, but let's just overnight, at the start of trading. I mean, it's 4:30, and then at 9:20, it's double. Barring us landing on the moon and finding rare metals overnight that signal the dawn of a new age, kind of thing. It's not going to happen. The larger point is that it creeps up. It goes from 12 to 13 to 14, et cetera, et cetera, et cetera. Or, whatever. It goes up and down, but it gets there over time. It doesn't just instantly, seismically, gap up like that. Mm-hmm. From that vantage point. Yes, wait, subject some sort of nuclear holocaust or something like that. Yeah, I don't expect it. And so
go down.
Yeah. No, but you know what I mean.
Let's be precise here about
yeah. I'm trying to think of an example of some sort of seismic move. I use Mars to go up. I'm using the nuclear holocaust thing to go down. But yeah, I mean, it happens over time. And what I'm getting at is little bets are being made every day based on those probabilities. And so it's not just there it is. It's at 30 and I never noticed it. It's an everyday occurrence. And so just because it's up, if you will, doesn't necessarily mean something's wrong. I mean, I would venture to say it's capitalism. Things should be hitting all-time highs constantly. Simply going back to the milk example, and forget the inflation that's happening right now, kind of thing, which is like, whoa, look at this craziness of eggs, right? But if I go and buy, it's not like anyone says, hey, Lucky Charms is at an all-time high today. You don't think about it. You kind of expect it. Yeah, it should cost more today than it did 10 years ago or than it did 20 years ago. Normal sort of inflation but normal kind of progress of time, if you will. And so I think what I'm trying to get at here is this sort of idea that markets are at an all-time high. PEs are at an all-time high. This is at an all-time high. I think that's a natural function of just the economy expanding, which is an expected headline, that you should embrace and not necessarily run for the hills because it's time for a retracement.
Yes, absolutely. And just to echo that point about, the PE ratio, no one's ever surprised by the PE ratio. Whenever it's gone up, that's because more people are buying at that point. They're saying absent earnings going down, but during the year, people are saying, yeah, I want more of that. I'm more than happy to pay for, whatever the PE ratio is. That's how this thing moves. And at every point, people have been happy with where that PE ratio is. So it's not that it can hit some trigger and then everything comes crashing down. A lot of people seem to be looking at it in that way, but that's just not how this works. It's a flow. It's not, something that's jumping out at you. So
the way I've heard advocates of that, the way I've heard them explain it is you attach a rubber band to the historical average value. And so as you move away from that, you're pulling on the rubber band. And so it's creating more and more pressure towards the middle. And at some point it could snap. But
the retort I've heard to whose side are you on anyways, Wade? No.
You really want to go and start the reversion of mean commentary here?
The retort, I just wanted to be funny. The retort I've heard to that is, okay, I get it, but how do you know that the historical average doesn't ever move? I think it was Weston actually that I first heard it from. Who do you know? What do you know about what the historical average should be? That it doesn't move. Yes, I can do the math and do a sum and an average and etc. and figure out historically it's the 18. But how do you know that it's not 19 now?
And William Bernstein had an article on that concept of as societies grow wealthier, the returns on capital decline. And so naturally that will push up the kind of average valuation level over time, and just a trend that you see over time.
That would be my retort as well, because I think it makes perfect sense. Okay, I get the whole, there's a rubber band thing, or trees don't go to the sky, trees don't grow to the sky, etc. But the reality is how do you know what that anchor point is? Where is that anchor point? And why does that? Where does it say that it has to be the same? Forever and ever and ever. You don't know that. The other thing that I kind of never get past, and you said it when you did your 50% thing, and this is kind of what this is my go-to when a buddy or something like that asks me about getting in and out, is if they don't buy the arguments of the PE stuff that we talked about or the fundamentals, or listen, the all-time high, and that's a natural kind of thing. You have to be right 50% of the time to get out or to get in. But then you have to be right but then to be right again. So being right twice, 50% times 50%, you're looking at a 25% shot here. And for what, really? And the worst thing you could do is be right on that one, because you're like a member for life, that kind of thing, it's like, unless you hit zero, you're going to double down, kind of. So you got to be very careful, because just look at the odds. Okay, you had a 25% chance that could happen. It's 1 out of 4. Congratulations, right? But then you do it again, and these are independent samples. But the odds that you're going to be right on 4 ways consecutively, just continue to multiply by 50% every time, every iteration, continuing to multiply by 50%, and those are the odds that you would have been correct for that many number of times. I mean, that alone, you would never do this with anything else, with any kind of decision, but with money, for whatever reason, it's like, yeah, you know what? I'm feeling good. Let's do it. And so just from a probability basis point of view, the odds are just stacked heavily against you. It's not saying you're not going to get it right once. It's not saying you're going to get it right twice. It's not worth it. And I said this, and something I want to point out, and how would you answer this? Because I'm just curious what your opinion is here, Wade and Bob. If someone says to you after listening to the last few podcasts, "Hey, folks, I've heard this, and let's cut out the chit chat at the start of the podcast to begin with," but as an aside, it seems to me that you're saying any potential reason that something is successful is by chance, or is by a random draw, and I have trouble digesting that because it seems like an easy out for you to say, yeah, but they're just lucky. Mm-hmm. What would you answer? What would be your answers?
So I would say, well, wait, let's let you go first. I want to see. I want to see you stumble through this answer before I do.
No, but it's a fair question, right?
It's an absolutely fair question.
Yeah, and I would lean towards the idea that there probably were lucky, and that with as many people in the world investing, just by random chance, there's going to be some people who have a string of consistently correct bets on whatever it is that they're looking to time. And so it's really hard to distinguish skill from luck. And this may be looking ahead to future episodes, but when you start looking at the studies of the performance and people who may have had a good string where they looked like they were skillful and knew what they were doing, but then you just do a reset. And now looking forward from that point, how do they do? They don't tend to be able to keep that performance up. And so I would not discount the role of luck in that sort of temporary overperformance that someone might have enjoyed.
Yeah, no, that was going to be my go-to answer there as well, actually. The subsequent performance studies, I think, are a very, very strong nail in the coffin here. And we'll talk about this in much more detail, I believe next week, actually.
Yeah.
Where, if you look at people who won in one period, that literally tells you almost nothing about what they'll do in the next period. It's a completely random shot after that. So, there definitely does seem to be some luck there. The other thing I would caution on here is that, it does matter, for a company, how we run RISA or Retirement Research or McLean, that matters a lot. But that information
that? What is that? Corporate finance issues matters a lot?
Yeah, just running a company, how much profit you're going to make, obviously.
Perfect. Yeah, I just wanted to get a sense of what you meant.
But all of that information gets absorbed into the stock price effectively immediately. That information is already in security prices. What matters is, how does that next piece of information square with what the market expects? So, right now, I guess Twitter is not a publicly traded company anymore, but Tesla, Elon Musk, the market, I think, has come to kind of the conclusion he's a little bit scattered right now. That's built into Tesla's price. If Elon Musk comes out and is a brilliant manager going forward, the stock price is going to go up. If he kind of keeps stumbling around, that's already in the price. That's already how people are expecting him to be acting.
And so you could is it fair to make the case? You're talking about a stock now. We kind of talked about that in the last sort of episode when we were bringing fundamental analysis. But you can make the case that same Tesla example generalizes to the U.S. economy if we were to take a PE valuation metric.
Absolutely.
And I would venture to say, when you're talking about the entire U.S. economy, I mean, you have more, there are more eyes on that, I would think, So it's like, what are you bringing to the table about the PE ratio that no one else knows? That you think somehow, you listened to CNBC the other day and Jamie Dimon was talking to Cramer and he told Cramer that expect inflation at 6%. And so you heard that before 99% of the other investors. And so, you acted quickly, use your mobile E-Trade thing and put in the order and off you go. I mean, and I'm exaggerating to make the point, but I don't think it's too far off.
That's not even an exaggeration. I mean, it gets back to, we talked about high frequency traders a little while back. the server farms they use, they literally measure out the cables to make sure that everyone in that server farm, their signals are traveling exactly the same length.
I wasn't even thinking like that. I was thinking like, what the hell does Jamie Dimon know that, everyone else doesn't know? And I respect Jamie Dimon as a great CEO, but I'm talking about market prognostications about where inflation is going or whatever. I don't care if he gets like top secret JP Morgan reports. It doesn't matter. Math is math.
Mm-hmm. Yeah, but so, I mean, to Bob's point on that, is if he did have the accurate information and he revealed it on a television show, you're going to have a hard time being the quickest actor to take advantage of that information.
Yeah, no. You're right. I think too, because we could say this, but I think there's a couple of attractions to market timing, regardless of levels. But I'm not even talking about the person that market times every day, because they're not listening to this. It's really more the person getting ready for retirement and they have a milestone decision to make and they're delaying it. Mm-hmm. Or they're acting a little quicker than they should be simply because of where the market is now. That's the market timing that I think is more troublesome for me. The other people, they kind of know what they're getting into. They have to, it's a pure consumerism kind of thing. This is more people that are, faux investing to some extent, and they're bringing in speculation to the mix. Mm-hmm. I think it's easy to see why, though, right? And I think it's because of the whole psychological piece where I feel pain. I'm going to remove that pain by selling or by, whatever. I don't feel the pain now, but guess what? The 50-50 chance, if it didn't hit, now you feel pain again and you reverse it. And then you just rinse, repeat over and over and over again. And then see what happens later. And that ruins retirements. I mean, how much did the success of market timing factor into your sustainable withdrawal rate studies?
Well, that's the thing about the sustainable withdrawal rate studies. They assume you stick to your asset allocation that was predetermined before the study. And so there is no market timing.
That's the point, right? The larger point is, who cares about when to get in, when to get out, et cetera? The folks that are listening to this are here for, retirement income, right? And so this is just not needed. You don't need to add this extra arrow, if you will. And that's giving it the nice assumption that you're going to be correct. Most likely it's going to be, what do you call the firecrackers that don't like shoot off? A dud. That's a dud. That's a dud in your sort of, in your quiver, if you will. I mean, you don't want to engage in that. There's no need to. And you gotta, got to try to hold off in that sense, because I can't stress enough, the probabilities are just so far against you that it's not a game you want to be playing at all. I mean, the other piece is, how much does greed, do you think, get involved in this, Wade and Bob? And I say this because if any, there's some advisors that listen to this, and there's that old chart, timing the market. And if you miss the best day, the return, I'm making it up, right? The return goes from 10% to 8%. If you miss the best week ever, it goes from 10% to, Bob, you want to take a guess?
I haven't done it at the week level. A couple years back,
but whatever. You know the story, how that story ends, right? Why don't you continue it?
Yeah. So there's always people on both sides of the argument. People saying market timing is the best thing in the world, and people saying market timing is bad. Who'll go and say, if you miss the best month, well, shoot, look at how bad it would have been. So you don't want to market time. Conversely, people will talk about, well, if you missed the worst month, well, look how much better you would have done. So clearly, just be good at it. And you can run these numbers and slice and dice them all the different ways. And yeah, the numbers look really friggin' good if you assume you can market time. Back in, I think it was in 2016, I ran some numbers. And, if you assume perfect market timing, so you're in the market when, you're in the S&P 500 when the markets are going up, and you flip over to, 1 month T-bills when the markets are going down. If you missed just the worst 10 months, this is from January 26 to July 2016, It went from slightly more than a 10% annualized return for the S&P 500 over that period. Just missing those worst 10 months, it jumps up to just over 13%. So a 3 percentage point difference. Conversely, and we'll use the growth of $1 here. If you miss the worst 10% of those months, so 109 months overall, just holding the S&P 500 over that period, $1 would have taken you to $5,800. If you missed the worst 10% of the months, that would have taken you from $1 to $254 million from 26 to 16. Obviously, great if you can get it. Just like Wade's example of, if the market doubles overnight, I'd love to try it, but it doesn't bode well. Conversely, we can get, just massive numbers the other ways. If you miss just the worst single month, you lose about $1,800 in terms of your growth of wealth coming from that $5,800. If you just miss the best month, that $5,800 drops down to $4,070. If we miss the best 10% of months, that $5,800 drops down to 31 cents. Every dollar turned into 31 cents there. So, it's fun to play with these numbers, and you can do all sorts of fun things, putting in lags and, measuring impreciseness and all that stuff. But what all of these really come down to is don't be bad at market timing if you're going to do it. Get it right.
That's your range.
That's your range.
And Bob, I like the number you ran where if you could perfectly time, you're in the market in any month that it went up, you're out of the market in any month that you went down, your $1 would have grown to be $356 trillion.
Yep.
In that 90-year period.
That's
not a bad outcome, huh?
Yeah. Yeah, that perfect timing strategy would be real nice if we could pull it off. Frankly, I would not be sitting here talking to you guys if I could pull off that perfect timing strategy. But
yeah, like I said, this is kind of a fool's errand. And the reality is you'll hear the stories from your neighbors and friends when they got it right, and they're going to tell everyone about it. But not many people are going to tell you when they got it wrong. And the other piece too is they could get it partially right, but they don't look at their opportunity cost. Hey, should I have just stayed in the market and not paid taxes and, got this and, et cetera, et cetera, et cetera. And they probably don't want to know, because they may find out that after 5 years of quasi market timing and being lucky, there are people, someone does win the lottery, right? After 5 years of this sort of thing where they think they've had some moderate success, they don't go back and say, oh, wow, you know what? If I would have just stuck with it and not bothered with this messiness, I'm better off. And you got to ask yourself too, why are you investing, right? Is it to kind of beat some arbitrary bogey or to make yourself feel good about like your investment prowess? Or is it to fund a retirement, maintain your standard of living so you could do the things you wanted to do on a goals-based level? I think it's the latter. And so at least the folks listening here. And so that's the important thing. You got to ask yourself why. Why do you want to even bother with this? Now, Wade and Bob, we spoke about market timing in general, how it's this sort of hybrid, how between fundamental and technical. We spoke about how there's market timing addicts, but then there's also the, in the closet market timers, which I think are dangerous because those guys are the ones that, or folks, do it with their nest egg. There's but I'm using fundamentals like PE ratios and CAPE ratios and things like that. So what is the answer? There's, it's the whole piece of, look, there's already, that's information that's out there. What about bubbles? Tiny bubbles. That's an old song. What about bubbles?
Okay.
I love Bob's. Okay, Bob goes like this when he goes, okay. Okay.
Yeah. You do.
He didn't say
Alex.
okay. He doesn't say okay. He said okay. Okay.
Yeah. Yeah. You do you. We'll just move on without comment here.
I think it's Don Ho or something. It's an old like Hawaiian singer. It's like one of those cocktail loungy songs. But
yeah, I said without comment here, Alex. So the thing with bubbles is there's a lot more of them predicted or talked about than actually happen. So there's always that issue that we got to be dealing with when we talk about, these big market movements. People are constantly predicting these things. I remember, I want to say, Wade, you might remember this. It was, I want to say 2017. The VIX, which is kind of the market's prediction of what the volatility in the S&P 500 will be next month. It was really, really low. And everyone was talking about how that's a sign that the market's just going to fall apart and everything is going to come crashing down.
Because no one is worried. And if no one is worried, that's when stuff hits the just proverbial
silly stuff gets put out there. And eventually, something's going to hit. It's I predicted 10 of the last 3 recessions or something like that, whatever that quote happens to be. I forget it off the top of my head.
That's pretty good, man.
It's exactly the same thing here. So there is that issue to deal with. The other is that how we think about bubbles and crashes, I think, is a little bit skewed. Alex, you made this point with regards to mean reversion. The historical average is X, but that's not to say that it's going to continue to be X, or that's the anchor point, if you will. It's the same thing with how we price risk. How we value risk, how we price risk moves through time, and it incorporates new information. And when that changes quickly, when we feel differently about the market and about our willingness to hold risk in the market, prices are going to move incredibly quickly. So, 2008, this is a good example. Because the mortgage market fell apart. What did that have to do with tech stocks? Seriously, what did that have to do with tech stocks or, some of these other parts of the economy? It didn't necessarily have anything to do with it. What it had to do with was how willing we were to hold risk. We all got really, really nervous for good reason. So we just didn't want any risk. We wanted to get rid of risk in our portfolio because we were also seeing how other people were reacting to it. And we basically didn't want to be left holding the bag. Well, that meant, we saw what that meant. That meant everyone sold and the market dropped by 40%. It's the same thing during a bubble. Look at the tech bubble. This is another easy example.
And I can't stress enough, a bubble is not like, things have been going up for 2 weeks. They're interviewing someone on TV and they say, there's a bubble in real estate or there's a bubble in semiconductors. They just do that because, hey, it's gone up too much over the last 2 weeks, so there's a bubble. It's become kind of common jargon, so it's reduced the emotional tenor of that word. Yeah. Bob is, when he uses bubble, he means it in terms of
this is South Seas bubble type of stuff.
Yeah.
So that's right.
Yeah, exactly.
And it's just the inverse of a crash. It's people are really, really excited about all these tech stocks, putting .com after their name. Actually, wait, you may have seen this paper a while back. There was a paper that came out, I want to say it was in 2001, where they looked at when companies changed their name to put .com at the end. And that actually moved stock prices, like materially moved stock prices for multiple months just by putting .com at the end of their name. People were so excited about this. They were devaluing that risk. They were so much more willing to hold those companies that they were willing to just buy up the price. Now,
but the way, because I could still be listening to this and still thinking, yeah, but that's why it's a bubble. That's why it's irrational, because there were two exuberant about this.
Sure,
irrationally so, right?
Yeah, but irrationally exuberant.
I would say, thank you, bud. Thank you for that.
That's right.
I would say this, and I think it could work the same way, and it ties into what we said earlier about people are making bets, probabilities. So think probability bets about the future. Think probability bets in terms of a spread, right? And so let's go back to the car companies when they first came out, Ford, GM, et cetera, et cetera. I think there were hundreds of car companies, right? The total addressable market, if everyone in the U.S. bought a car, imagine that, right? The total addressable market, I don't know, to make up a number, let's just say $100 billion. I have no idea if that's even tied to reality back then, but it probably isn't actually. But let's just say $100 billion to make the math easy, right? There are 1,000 car companies. People don't equal weight the probabilities that everyone is going to win, right? But they say, okay, Ford has a 30% chance. GM has a whatever 10% chance. I don't know any more car companies that were around back then.
13% chance. Yeah.
Studebaker, whatever, et cetera, et cetera, et cetera, right? And so those things though don't add up to 100. It could be beyond. They don't add up to 100%. It could be beyond 100%. Because there could be a winner take all component. It could be this or that. But the point is that they're betting the probabilities that these particular companies, even the .coms, are going to hit that total addressable market. And there's only going to be a few winners, right? And so they're betting that. And that's why it goes up like crazy, because this is to your point, Bob. Mm-hmm. They're betting on the probability that this is going to happen. And if my company wins, which I have a 20% chance of this, and you tie it to the $1 billion market cap, then it should be worth $200 million, that kind of thing. But as news comes in every day, and news comes in fast and furious sometimes, when it becomes obvious there's only going to be two winners, and it's most likely going to be these two winners, everything pops for the other ones. It's like the day after a game. The day after a game, there are no more bets for the previous day. You know what I mean? They're already in. They're done. No one's going to continue to bet. No one says the bubble crashed on Sunday Night Football. No, it's over. It became known. The outcome became known. So everything recalibrates. Sorry, Bob, you want to jump in?
That's a really, really important point, that a lot of bubbles, a lot of what we talk about as bubbles, are really hindsight. These are still the same people. In 2003, it was still the same people as the people bidding up the prices in 1999. They thought they were doing what made sense at the time. And it's only by looking at it after the fact that we can really say, yeah, that was dumb. We shouldn't have valued risk that way. We shouldn't have, everyone should have known Studebaker was going to go out of business. So that was dumb. Why would we have done that?
Yeah, but at that time, you were applying a 10% chance of success in a total addressable market of $100 billion. So, hey, that's what it's worth.
You know, do the math. The information
X times. Yes. So that's how I that's what I can hang my hat on when I think about bubbles, in terms of, sure, there's some enthusiasm on it, but I still think they're pricing probabilities, for a total addressable market. If there's this new sort of thing that's out there, you're going to see that now with AI, right? They're effectively saying, every few years, there was the internet, there was mobile. Now this sort of is a generational thing, right? And there's going to be companies now that are going to sprout up because the funding for venture for that kind of company is very hot right now. So you're going to see hundreds of these companies pop up. They're going to figure out what the total addressable market is for this kind of seismic shift paradigm, if you will. And people are going to place their bets, knowing full well that 500 of these new companies, they know that 500 of these new companies are not going to succeed, but they're going to take their bets, based on the probabilities that they will succeed. It's going to lift all ships, but then as the music starts playing, chairs start being removed.
Absolutely.
That's my thing on bubbles, and that's what I'm sticking to. Wade, what do you have?
Sounds like there's not a bubble.
Well, I don't know. I mean, look, we're talking here because we're opinionated folks, and we're kind of not hedging what we say, this or that. Who knows? I'm willing to be wrong, right? But ultimately, that's a kind of that's something that aligns with everything that I know and that I've learned with regards to investing, and the philosophy that I subscribe to, which from my vantage point is the most empirically sound. You can make the case capitalism, right? It's a great system, even though it's terrible. It's the best one we have.
Yeah. No, I come out from a slightly different take that people can be really, really dumb. It's just, I'm a person and I don't necessarily know when someone's being dumb. It could be, when we're looking at these prices coming up, maybe they should be this high. I don't know. And it's only by looking back after the fact we can say, yeah, that was dumb. The prices shouldn't have moved like that. But with the available information at the time, with how people were reacting to that information, people were paying those prices. And I don't know how to systematically say, or even on a case-by-case basis say, this isn't real. And until I can do that reliably, it's irresponsible to try and guess.
So maybe to just wrap things up then, we could be a little more explicit on the idea that if you're not going to market time, what's the alternative? what are you supposed to do?
Yeah, the alternative is kind of be boring. Don't market time. It's to build your systematic entirety of your retirement income plan around where it is that you want to go, and build a portfolio, build an investment portfolio that helps you towards that point, that helps you reach those goals, and then stick with it.
So invest when you have the money available, sell when you need the money to spend, and don't get caught up in trying to say, oh, maybe I should wait a week before I invest because I think the market's about to go down. It's if you've got over time, markets tend to go up. And so time in the market, if you have funds to invest, go ahead and get it in the market and don't try to time those decisions.
Yeah, view your role as a price taker. And, you're it goes back to yesterday. It goes back to the last 3 episodes last week, I meant, which is like, listen, accept market returns and harvest those gains. You're on the coattails of capitalism. Try not to be too cute by half by timing, by using technical analysis. And frankly, fundamental analysis is it's not bad. It just doesn't serve you in the way you think it does. It serves the passive investors. Yep. So I thank you for your service, but for doing that. But and again, the last 3 episodes, we've just said it conceptually. In the next one, we'll go over the numbers, because to your point, if it works, then I'll be able to show you, look at all these technical analysis people that have succeeded. Look at all these fundamental analysis people that have succeeded. Look at all these successful market timers, but with a caveat. And Wade alluded to it earlier. More than what would be predicted by chance. Because I can point out to people that have done well. But that doesn't mean anything unless I can point out to more people than what would have been predicted by chance than a random sample would have succeeded in. And we'll get to that in the next episode. Dun dun dun.
Okay. Well, thanks everyone for listening, and we will catch you next week when we look at the actual performance of investors over time.
Take care, everyone.